One, one, two. Check me out.
Premium financing. Some say it's too risky, and that the assumptions that premium financiers make are unrealistic, leaving clients to believe in something that may never happen. So, is it too good to be true? Or is premium financing the best thing since sliced bread? And if it is the best thing since sliced bread, well then why doesn't everyone do it? Well, there are several reasons. One is that most insurance carriers typically don't allow clients to premium finance their life insurance policies if their net worth is below $5 million. And two, for clients whose net worth is over $5 million, there are some legitimate risks to take into consideration, like borrowing rate increases and collateral requirement increases as well. Plus, in traditional premium financing arrangements, clients do have to sign a personal guarantee on the new debt. Well, at Landsmark Capital, we understand these concerns, and we designed one of our premium financing programs to eliminate all of these risks. Because there are some premium financing programs out there that are very deceptive and extremely risky. But we take a much more conservative approach, giving our clients peace of mind. First off, one of our programs is so conservative that 2 insurance carriers allow our clients to use our premium financing program even if their net worth is far below $5 million, as long as they have a minimum income of $200,000 a year. And to address the risk of borrowing rate increases, we co-developed an exclusive program with lender Gracie Point, wherein we can offer a guaranteed 10-year fixed borrowing rate, eliminating rate increase concerns. This is an exclusive program we developed with Gracie Point and can only be accessed through Landsmark Capital. This lending package does not require any outside collateral, and the client does not need to sign a personal guarantee on the loan either. The policy serves as the sole collateral. So for those clients that are debt adverse, eliminating the personal guarantee requirement is huge. Plus we have a turnkey, all-inclusive package where one of our trusted law firms sets up a single-member, special-purpose Florida LLC to own the policy. And the setup costs and the annual filings with the state of Florida are all included in the fixed client outlay, making it simple and easy for our clients. The only variable left in the program is policy performance, which is the same variable that exists in a non-financed life insurance policy. And our proprietary software can model this in a true apples-to-apples comparison, back-tested and stress-tested. So if you compare our 10-year Omakase premium finance program to a non-finance 10-pay using the exact same product from the exact same carrier using the exact same outlay, our program produces an initial face amount almost 3 times larger, substantially more cash value accumulation and income drawdowns, 56.46% more to be exact, and our IRR is more than 2 full points higher. And the target? Well, it's almost double, with no interest rate increase concerns and no collateral concerns, and no personal guarantee requirements on the loan either, which is great for clients that say they're debt adverse. We call this responsible leverage, where we measure and evaluate the risks, and then mitigate them or completely eliminate them, based on our client's risk tolerance. So no snake oil gimmicks, no interest accrual, no high early cash value riders, just logical, indisputable math, giving our clients certainty and peace of mind. So if you want a premium financing program with a fixed client outlay, a fixed 10-year borrowing rate, where we can finance policies as little as only $200,000 in annual premium, well, check us out at LandsmarkCapital.com. You'll be glad you did. This is Darren Sugiyama, Managing Partner of Landsmark Capital, and wanted to welcome everyone to this webinar. On this webinar, we are going to take a look at a case study comparing a non-financed 10-pay IUL to our Omakase Premium Financing Program. So let's go ahead and start out by looking at the non-financed 10-pay IUL. Again, pretty basic. We're going to have the client pay $50,000 per year in annual premium for a period of 10 years. And that is going to buy them $1.2 million in initial face amount. We're going to show income drawdowns from this policy starting in year 20, which would put the client at age 65. And in this case, assuming a 5.50% index return, gross index return, the client would be able to pull down $102,000 per year, starting again at age 65. And in this case, we're showing a 40-year run here. Okay, as a comparison, we're going to look at our Omakase level-funded premium financing program. And this is a very unique program where we have the client pay the exact same annual outlay of $50,000. That $50,000, some of it is going to go towards paying what we call equity premiums, essentially premiums paid out of pocket. And some of that $50,000 budget is going to pay the interest on additional lender-funded borrowed premiums. So let's take a look at the ledger here. Again, this is a 10-pay design. Again, same exact IUL product, funded a little bit differently here. So we have the client now contributing $50,000 per year for the same 10-year period. Now, of that $50,000, some of that is going to pay equity premiums, again, and some of it is going to pay the interest on borrowed premiums. In this design, the face amount is substantially higher at $3.37 million versus only $1.22 million in the non-finance policy. Again, same exact carrier, same exact product. And if we look at the drawdowns there, the drawdowns are substantially larger at $162,000 per year in income drawdowns versus $102,000 per year in drawdowns. So let's take a look at the premium design. And the green box that just popped up in the top left-hand corner of the screen, that is the amount of equity premiums that are being paid directly to the carrier from the insured person or from the client. And those premiums are coming from the $50,000 annual budget. Now, the balance of that is going to go towards interest payments on the borrowed premiums. So in that red column you just saw pop up there, those are the premiums borrowed from the third-party lender. Again, the client is going to pay interest on those borrowed premiums, and that is the additional green column that just popped up. Now we're showing a fixed rate of 4.5% on the borrowing rate. We have a proprietary 10-year fixed borrowing program through Gracie Point. We're the only ones in the country that have access to this particular loan arrangement. Again, it is a 10-year program, and that rate is fixed at 4.5% for the full 10 years. So we see that the $50,000 annual budget is going towards paying some of those equity premiums as well as some of the interest payments and loan fees on the borrowed premiums. Now, the beautiful thing about having a fixed borrowing rate at 4.5% is we can predict what the exact interest payment is going to be each year for each of those 10 years because it is a 10-year fixed borrowing rate program. And then we pay off the third-party loan in year 11 from the policy values. So let's take a look at kind of a summary here. Again, we have $50,000 per year being contributed into both the non-finance policy in the form of premium, and in the Omakase program, we also have that same $50,000 being contributed that is a mix of equity premiums and interest on borrowed premiums. So right off the bat, we have, again, a substantially larger face amount in our Omakase program, almost triple that of what is the 10-pay non-finance IUL provides. And if we look at the income drawdowns, again, substantial difference, much more income being drawn down out of the Omakase program. A lot of that is because of the greater premiums being leveraged using the bank capital going into the Omakase program. Again, remember, same carrier, same product, same everything in this particular example. Okay. When we look at the 40-year net cash surrender value on both sides, we have a little bit more in the Omakase setup, but again, substantially more income drawdown. So if we add the income drawdowns, the total income drawdowns to the net cash surrender value net of loans in the 40th year of the policy, it's a substantial swing in the amount of $1.3 million in favor of the Omakase program. That is a cash benefit increase of 56.46%. So huge benefit. And again, if we look at the IRRs on both sides, it's not even close. Now, the target premium is also greater in the Omakase program because, again, you've got a higher face amount, you've got more premium going in. And so to execute this program, let's talk a little bit about our rules and fees at Landsmark Capital. So we put together the case design and as well as generate the proposal. We can also assist the advisor or the agent in the point of sale process. It usually works better the more they involve us in that process. We can answer any questions that the client has, or their CPA, or their AUM advisor. If they have any questions about any of the moving parts here, we can certainly address those and get as granular as they want to get. And we also arrange the loan with the lender. Again, in this particular program, we use Gracie Point. This is our proprietary 10-year fixed rate program. We get that rate locked in for the full 10 years. So we're removing all of the variables that most folks are concerned about when it comes to premium financing. What happens if the borrowing rate goes up? Well, we have a fixed borrow rate for the full 10 years, and then we're exiting the loan right after 10 years in year 11. There are also no collateral issues in this case because the loan to value is in such a healthy position. The cash surrender value of the policy is always in a greater position or is a greater amount than the principal loan balance. So the policy can serve as the sole collateral. We handle all of the loan underwriting, again, orchestrating the loan with the lender. And we also have a turnkey process where we have a law firm it's an international law firm out of the East Coast called Lowndes. We have negotiated a fantastic low rate for them to set up a single purpose LLC that is going to own the policy. All of those setup fees and annual state of Florida maintenance fees that go into or that encompass the LLC filing and all that sort of thing, all of those fees are embedded in the loan fees. So the client does not need to pay any more out of pocket than what we talked about. If the client, in this case, is paying $50,000 per year funding the program, all of those expenses are encompassed in that $50,000 annual budget. We also set up an independent manager that's going to manage that LLC. The independent manager is kind of analogous to a trustee on a trust. They're going to, again, file all the filings and manage the LLC during that first 10-year period. The attorney that does that, again, their fees are also paid for out of the loan fees. So everything is all inclusive in that client budget. So nice and clean and simple, again, totally turnkey. And for all of this, we take a 33% commission split on the back of the application. Now, I know a lot of advisors that may be new to premium financing, or perhaps they've never worked with an intermediary before or never done joint work before. Their biggest beef is they don't want to give up a commission split. And I understand that. So if we look at the target, when we compare the target premium on the non-finance policy that they would sell on their own without us, would be $20,539. The target premium in the Omakase program, in the bottom right-hand corner, when we see $26,186 in target premium, that is actually the agent's net target premium after our 33% split. The actual gross target on the Omakase program is $39,083. So almost $40,000. It's almost twice the gross target as the non-finance policy. So the net target going to the advisor that brings us the case, they are actually going to make 27.49% more commission than they would have had they sold this case on their own in a non-financed arrangement. So everyone wins here. The client gets, again, almost triple the death benefit. They get 56% more cash benefit as it pertains to income drawdowns and cash value over time. And the agent makes a little bit more money. Again, 27% more commission. So again, win-win-win for everybody. Okay. The last thing I'll talk about here is we have a very unique proprietary software program that we developed in-house where we can actually backtest and stress test the viability of the IUL product or the IUL chassis in terms of the crediting method and the expenses and charges. So everything we do at Landsmark Capital is based on what we call the indisputable mathematical truth. When it comes to math, opinions don't matter, feelings don't matter. The math either works or it does not work, and the math either works better or it works worse. So we truly have proof of concept when it comes to our program. So let's talk about how we backtest. We basically take the policy illustration data, the charges, the crediting methods, the premiums, et cetera, et cetera. We dump that into our software program, and then we reconstruct the policy during times of volatility. So we use 3 different 40-year periods to, again, backtest and stress test how this program would have worked during different periods of time. The first one we do is pretty simple. That's just the last 40 years of S&P performance. The numbers you see on the screen there in the right-hand column, those are the S&P returns during those years, not including S&P dividends. And when we look at the compounded annual growth rate of the S&P 500 over the last 40 years, including the S&P dividends, the compound annual growth rate was 11.84%. And without S&P dividends, the compounded annual growth rate was 8.86%. So the reason we talk about the compound annual growth rate is just to give the advisor and the client some context in terms of what type of market environment are we looking at here. So again, this is the last 40 years of S&P performance. We also take a look at the last 20 years of S&P performance, and the reason is because the S&P did not do as well over the last 20 years as it did over the last 40 years. About half as good, actually. So we take that 20-year period and we run it back to back to create a hypothetical 40-year period. Again, this is just the last 20 years of the S&P 500 repeated back to back. As we see here, the compound annual growth rate of the S&P during this time, this constructed time period, I should say, is 6.01% with dividends and 3.99% without the S&P dividends. And of course, in an IUL, the crediting method is based off of the S&P returns, or is correlated with the S&P returns, not including the S&P dividends. And then the third 40-year period that we construct here, we call this the sandwich. The reason we call it the sandwich is that at both ends, the first 10 years, years 1 through 10, and then the last 10 years, years 31 through 40, we're using the lost decade, which is the period between the years 2000 and 2009. This 10-year period was an awful period. As we see there, we have 4 negative returns out of those 10 years. We have the dot-com bubble in years 2000, 2001, 2002, and then, of course, the glorious 2008, crash of 2008. So we use those 10-year periods on both ends of this 40-year constructed period, and sandwiched in between those 2 decades is the last 20-year period. This is a doom and gloom, very unrealistic worst-case scenario, in which case the compound annual growth rate of this 40-year period would have been 2.45% with S&P dividends and 59 basis points without the S&P dividends. So again, why do we even show such a negative 40-year run? It's such an unrealistic 40-year run. The reason is because if our program proves positive mathematically during this very unrealistic worst-case scenario, everyone goes to sleep well at night because they know that the program is beyond solid. So we believe our Omakase program is great. We believe the returns are great. But the biggest question is, from an accumulation standpoint or an investment alternative standpoint, great compared to what? So what we compare it to is actually we compare it to a hypothetical managed investment account that we construct. We will usually use a combination of equities and bonds, a 70-30 equity to bond ratio. For the equity returns, we're using historical S&P 500 returns, including the S&P dividends. And for the bond allocation, we use historical 10-year T-bond returns. We are also going to include an advisor fee of only 50 basis points. So with a 50 basis point advisor fee, plus the fund manager fee, plus the broker-dealer fee, that's going to equal roughly a 1.35% all-in investment fee, which creates a drag on the returns in this particular fund. And then we're also going to assume that the client is a California resident, married with a $400,000 household income. And we're also going to assume they're 46 years old and they were rated preferred non-tobacco in the life insurance policy. So this is the same client demographic as the first example that we reviewed earlier on this webinar. Okay, we're going to compare this hypothetical managed investment account to our Omakase program. We are using we call it a hypothetical index account for compliance purposes. Okay, so we do not say that this is a life insurance policy by any particular carrier. We are basically just saying that this is a hypothetical index account that just so happens to have a crediting method similar or the same as that IUL. So in this case, this hypothetical index account has a 0% protective floor and a 9.75% cap. It also has a 1% multiplier charge or an asset-based charge. And for that, that is buying a 1.45x multiplier bonus. And even with that multiplier bonus in this particular crediting method, that is going to put a max cap of 12.75%. Again, this is not a life insurance policy. This is a hypothetical index fund that just so happens to have similar charges, crediting methods, caps and floors as that product. So that's my disclaimer. Okay, so we run this comparison, again, during those 3 different 40-year back-tested periods. This is what it looks like over the last 40 years. The green line is the account that we are calling a hypothetical index account with the floor and the cap. And then the blue line is the hypothetical managed investment account. Huge advantage to the green line. Same thing with the 20-year look back. Tremendous growth over the hypothetical managed investment account. And then the sandwich, same thing. So why the huge disparity in returns and account value over that 40-year period? Several reasons. One, with our program, the client incurs far less risk. Why? Well, because of the 0% floor crediting method. In addition, the tax treatment is superior because, again, in the comparison, the hypothetical managed investment account is a taxable after-tax funded investment account. So it's getting a combination of short-term and long-term capital gains tax drag on an annual basis that's really pulling that net return down. And then obviously, well, not obviously, maybe new information to many people on this call is that the IUL chassis, the policy charges, as a percentage of asset are substantially less than most managed investment accounts, which we'll look at in just a second. And then the last huge advantage that our program has is the leverage, right? In our Omakase program, there are substantially larger premiums going into the index account, but the client is, again, paying a combination of premium and interest. So the outlay, while it may only be $50,000 per year, the actual premium going into the policy is over 6 figures per year. And then in the managed investment account, we are using that same $50,000 annual outlay. So the leverage that the lender capital provides in our Omakase premium financing program really supercharges the gains initially, and then even when we execute the third-party loan payoff, we are using an indexed loan or a participating loan. So the actual policy average monthly accumulated value of the policy, which is what the index credit is crediting on, remains at that much higher dollar value because the funds are staying in the indexed account. Okay, but let's get back to the fees here. This is a real eye-opener for a lot of people that have not really dug into policy charges. We actually have our policy charge page that we can show the client. Again, this is the last 40 years of the S&P performance. But we take the standard policy charges, which would include the premium load charges, admin fees, cost of insurance, rider charges, etc. And that's in the right-hand column of that red box that just popped up. And then we also calculate what the multiplier charges would be. In other words, the asset-based charge of 1%. So when we look at those fees, again, we're looking at the total policy charges here, both the multiplier charges and the standard charges. And when we look at the average charge over a 40-year period, the average annual charge in this policy, including the multiplier charge, is 3.93%. Now, if you look at the beginning of the policy, obviously the policy charges are greatly front-loaded in the first few years. So if we just look at years 5 through 40 and take the average annual charge as a percentage of asset, it's only 1.81% all in. And that includes the multiplier charge. So if you compare that to the charges in a taxable managed investment account, depending on who the advisor is, those charges could be very similar, if not lower. In fact, Forbes says the average mutual fund expense is 3.1%, 3.17% to be exact. So in this case, the charges in years 5 through 40 are substantially less than the average mutual fund expense. But the next thing we're going to look at here are the charges not including the multiplier charge, just the standard policy charges. And in years 1 through 40, the standard policy charge, total charges, are 2.94% per year. And in years 5 through 40, the charge is the average charge over that period of time is only 83 basis points as a percentage of the accumulated value. So we're talking about policy charges that are substantially lower than the average mutual fund expense. And even if you have an AUM advisor that's only charging you, say, 50 basis points, still very, very competitive. So at Lansmar Capital, we always say, look, the math doesn't lie, right? This is not my opinion. This is not how I feel. This is the stripped down, raw mathematical outcome, the indisputable mathematical outcome. So as we wrap up here, we'll talk about the loan features. Regarding the loan features, again, this is a 10-year fixed borrowing rate that's locked in for the full 10 years. It only gets underwritten once up front, similar to entering a 30-year fixed mortgage, right? They underwrite you up front, and then you're locked in there for 30 years. In this case, you're locked in at that 4.5% borrowing rate for the full 10 years. Nothing to worry about in terms of borrowing rate increases during that initial stage. The policy serves as the sole collateral, so the client does not need to post any outside collateral. The only time that would ever happen during that 10 years of initial funding, because remember, the third-party lender is paid off in year 11, so you only have a 10-year window of liability in terms of the collateral there. I actually had a CPA ask me, what has to happen to trigger an outside collateral call? So we stress tested it. In most cases, these policies would require 7 or 8 zeros in a row in the first 7 or 8 years of the policy to trigger an outside collateral requirement. Now, all that being said, even though the policy would trigger outside collateral, the borrower still is not required to sign a personal guarantee. In fact, in the loan document, it literally says there is no personal guarantee being signed by the lender / insured person. So huge benefit there. No personal guarantee. We also do not do any interest accrual in this model. I know there's a lot of programs out there that show the client paying a fixed amount for a certain period of time, whether it's 5 years or 10 years. And the way that they're designing it is that they are accruing the interest. In other words, they're saying, don't pay the full interest on this. Just pay some of the interest in the beginning and roll the rest of the interest that you're not going to pay back into the principal loan balance. And then after you get outside a certain window, don't pay any of the interest. Just roll it back, capitalize it back into the principal loan balance. So what ends up happening is now the client has compounding debt working against them, and that loan to the third-party lender keeps growing and growing and growing exponentially because of the compound debt interest. So it can be very, very damaging to the client. The illusion that these programs use out there is they may show the policy crediting at, say, 6%, and the client borrowing from the third party lender at a rate of 3%. Well, geez, it doesn't take a rocket scientist to figure out that if you're borrowing at a rate of 3 and the index is crediting at a rate of 6, you've got positive interest arbitrage all the way out into perpetuity every year. Well, we know one thing's for sure, and that is that will never happen. You're going to have volatility. So the interest accrual programs are very, very risky. I'm telling you, you're setting yourself up as an advisor. You're setting yourself up for a future lawsuit if you enter one of those interest accrual programs that is accumulation and income drawdown focused, which we'll talk about again as we wrap up here. The policy design features, we do not use any high early cash value riders. We don't have to because we have the client paying equity premiums from the very beginning. So no high early cash value riders, no spread comp, and no extended chargeback tail like you have in some of these spread comp, high early cash value rider type of designs. In fact, if you go to our website at landsmarkcapital.com and you click on videos and recorded webinars, on our homepage, it'll jump you to this page right here. And we have several different video recorded webinars that we've done. The one right here that says interest accrual epic fail, that's the one you want to watch. If you are considering doing one of these interest accrual type models, I won't name the names of those programs or the intermediary firms that promote them, but I'm sure you know who they are. There's about 4 of them out there that are pretty popular. Before you do anything like that, watch this video. I show a case study in this video of a program that looks really good on paper, and when we started stress testing it, the whole thing falls apart. And so again, without getting too much into detail there, go to our website, watch this video, and it'll be a real eye-opener for you. As we wrap up here, my business partner, Jeff Fain, and I published this book last year in 2019. It's called The Definitive Book on Premium Financing, The Good, Bad, Ugly, and Insane Practices Used in a Controversial Industry. You can get that on Amazon. There's also a link on our website. And in this book, we really walk you through the details of all of the variables that you should consider if you're considering premium financing a life insurance policy, and where all of the holes and gotchas are. So appreciate you guys being on the webinar. Hope this was educational. You can contact us through our primary website, and that is landsmarkcapital.com. We also have a client-friendly website for our Omakase program, and that is myomakase.com, MYOMAKASE. And there's also a link on our primary Landsmark Capital website that will jump you to that site as well, where we go through case studies and explain all the bells and whistles and features and benefits of our Omakase program. So again, look forward to talking to you guys soon. Visit landsmarkcapital.com, and we will be in touch. And for everyone out there, have a great rest of your day.